So the mergers and acquisitions are definitely taking place. The biggest problem I have and why I'm not going headfirst in this market is that I do think valuations are getting stretched when we look at the market as a whole. Well, the new year is a few short days away, and I hope everybody had a Merry Christmas. But it's time to get back to work. It's time to get back to the grind, especially if you're an individual stock picker. And I'm going to tell you where my portfolio is currently, what I'm currently looking at, and a few interesting things that are taking place with price action in the market. Now, market's starting to reach extreme greed readings, which means that we're getting to overbought conditions. There's a lot of euphoric behavior within the market, and we're just right around the corner of new highs. Now, most indices are pretty much flat on the day, nothing to really talk about, but we are definitely knocking on the door on the S&P 500 of breaking out of new highs here. But I have to admit that the price action across the board is pretty interesting here. We're seeing gold still rallying here. Crude oil now dipping over 1%, under $75 a barrel, to me is starting to signal something pretty interesting here. With all the geopolitical tension taking place, and supposedly heading into a hot economy, I'm actually surprised that oil is responding like this. And this is going to be an interesting thing to watch as we get through the first quarter of 2024, as earnings are going to be kicking off here really soon. And the first couple weeks of January are going to be a telling story, as we do have a January FOMC meeting. And I'm going to tell you why I'm currently sitting back here and why I'm sitting in treasuries. Starting this challenge in 2024, I sold out of all my positions, but you can see here that I've had a pretty nice run over the last 3 months or so. And here we are with the majority of our money now sitting in treasuries. I definitely have some money still sitting on the sidelines, ready to purchase any sort of disconnects that I see. We're going to get to some stocks here really quick. We sold out of our positions to start this challenge. So now I want to touch on laggers, but I specifically want to touch on a tech company here that deals with cloud, software, security, and AI. I'm talking about Cisco Systems. This company's kind of been trading flat over the last few years. It has its ups, it has its downs, but basically between $40 to $55 is where you normally find the stock trading. And I want to go over the fundamentals of the company, recent acquisitions, and why I want to buy this stock on a big pullback and for a long-term hold, and it to be possibly one of my larger positions. Now, when we think about where this company's focus is, it is in all the important sectors that everybody's pushing on us. AI capabilities, security, cloud computing, all these things we're putting extremely high multiple on a lot of the growth stocks that are coming in these sectors. But yet, here is a legacy company trading at a forward PE sitting maybe close to 14, 15 times earnings, a company that's been fiscally responsible, paying dividends, and is making cash acquisitions. Current PE ratio is sitting at 15 times earnings, not too cheap, not too expensive, kind of in a sweet spot here. And as you can see by the chart, as I stated, basically trading sideways for over the last 5 years. But why I think this is an opportunity is going to be kind of threefold here. Number one, they've been buying back stock, and they're continuing to buy back stock. Number two, they've been making good acquisitions. I think they're overpaying for some of these acquisitions, but I also think they have the ability to overpay, and I think they're buying good quality companies where they can overpay short term, but in the long term, it's definitely going to be beneficial. Love the Splunk deal, and there's talks of them acquiring a private company called Valent, a leader in cloud networking and security. So they're starting to make some interesting acquisitions that I think are going to be tremendous long-term investments for the company. Along with that, we're seeing that the price action over the last 5 years has remained pretty much sideways, while most of its peers have gotten multiple expansion, trading at 20 plus times earnings, while this company's trading at 15 times earnings. We've watched them steadily grow their top line revenue, but when we bring that down to operational income, they've grown operating income very nicely, doing over $15 billion of operating income. And with that top line revenue growth, buying back stock, recent acquisitions, we can see that when we bring it down to a per share earning basis, this is a company that was doing $2.60 of earnings, now doing over $3 worth of earnings. And so fundamentally, the company's growing stronger and stronger and stronger, making good acquisitions, but not really getting the price discovery that I think it personally deserves. Now, when I run my valuations on the company, projecting out right around 5% revenue growth going forward, ideally, I want to be buying the stock in the high 30s to low 40s. And so it is a little bit overpriced for me, but I am running pretty conservative expectations for the company as well. So when I look at Cisco Systems overall, like the acquisitions, fundamentally, I think it's a strong company, pays dividends, buys back stock. Valuation seems fairly reasonable here. I do want to see a little bit of a pullback, but this is definitely one I'm extremely interested in owning in 2024 and for the future of AI, security, and cloud computing. Another company doing similar things here, making acquisitions, and fundamentally has been a solid company, paying dividends, is Bristol Myers Squibb. This one is also knocking on the door in the high 30s to the mid 40s. That's personally with my analysis and what I'm projecting out for the company is the price target I'm looking for Bristol Myers Squibb. Pretty ugly 5-year chart overall, but when we look at the fundamentals of the company and the recent acquisitions, I don't think you can count this one out. When we look at the 52-week range in the stock sitting at $48 a share, up to as high as $75 a share. We can see the volatility here with the stock, but as I stated before, definitely interested in the high 30s to mid 40s on a company like Bristol Myers Squibb long-term. Once again, these are two stocks that have been laggers in this recent rally that I think have a tremendous opportunity more longer term. So if you have a long-term time horizon and we get some pretty solid pullbacks in this market, personally, these are two companies that I would look at. But as I always state, guys, this is not financial advice. This is just me starting to look at opportunities that are presenting themselves. Always recommend buying a broadly diversified index. Set it, forget it, and don't worry about the stresses of individual stock picking. Now I want to touch on the Warner Brothers Discovery Paramount rumors of a possible merger taking place here. Warner Brothers Discovery to me was kind of a higher risk play here when we factor in the debt. They haven't been able to prove profitability, and this price target's a little old, but I still think it hits on the right points here, where I have an $8 to $10 price target on a company like Warner Brothers Discovery, and I want to talk through this acquisition here because I also do have a price target on Paramount, which is closer to a $15 price target. So when we take a look at Warner Brothers Discovery, you're looking at a $27 billion market cap, and that doesn't seem too expensive, but we have to factor in is the amount of debt that this company's carrying. Total debt is sitting at $48.9 billion. Streaming is still trying to figure itself out, and so we're starting to see a possible consolidation take place in the streaming game. And I definitely think when we look at a content library standpoint, if Paramount and Warner Brothers Discovery did merge together, which I do think would be a complete stock deal overall, and I do think it would be dilutive short term to possibly shareholders, so I wouldn't be interested in buying it right away, but I would be interested in seeing what the fundamentals start to look like if there is some synergies here and there could be some cost savings as well. Both businesses are starting to take on a lot of toxic debt and haven't really been proven to really get the streaming game in the right direction. And so we're basically getting two businesses that have been kind of failing here and flailing, coming together as one. And yes, while the content library could be very strong, and I do think content is king, because now in the conversation of Netflix and Disney, if Paramount and Warner Brothers Discovery do merge and we have that live sports with a great content library, it's going to be a competition for sure, I think, for the two big streamers here. The question is going to be, can the fundamentals get stronger if these two companies merge? And that's going to be the biggest question I have. And so kind of what we've been talking about last year, I stated that we're going to start seeing a lot of mergers and acquisitions take place in a higher interest rate environment. That's absolutely what's taking place. I mean, we try to stay on top of a lot of the mergers and acquisitions, so feel free to watch some other videos that I have about some of the mergers that have been taking place. And this is the easiest way for more mature companies to add some top line revenue growth, build out their portfolios. And so you really have to start looking at these mergers separately. As I stated before, I think Cisco's mergers and acquisitions are interesting. I do think Paramount and Warner Brothers merging together would be interesting. I think it could be dilutive short term. I think there could be a lot of questions, but if they can get the fundamentals under control, could be an interesting dark horse winner in the streaming wars. We're starting to see a lot of M&A take place with biotech companies as well, as we mentioned with Pfizer in the past and also with Bristol Myers Squibb. Yes, there's some bits and pieces here that I think are on sale, laggers that haven't been really outperforming, that I think you can actually start looking at or possibly buying. Some of the names I mentioned today are definitely in those wheelhouses. Obviously, I'd like to see a pullback on some of those names because the way I'm running my valuations, I still need them to come down a little bit. But these are very interesting companies, I think, to own long term. Let me know what your thoughts are on some of the companies we talked about today. And as always, appreciate your time. We will see you in the next one.